Good afternoon, everyone. My name is John Gemini, EVP of Production here at Angel Oak Mortgage Solutions. Really excited today to bring to you not just a first time we've ever done just a condo webinar here, but I've got the OGs of the Angel Oak Mortgage Solutions team here. So we're going to talk about all the recent or the upcoming or pending agency changes on condos. So we want to kind of educate you on what non-warrantable will be able to do for you. And so we're going to talk about all things condominiums and non-warrantable condominiums. So we'll let everyone log into here for another 30 seconds, and then I'll introduce our two subject matter experts here, and they're located in Florida, so they know a lot. They know how to close a lot of condominiums, and they've closed them for 10 to 13 years here at Angel Oak Mortgage Solutions. So hope everyone's having a great kickoff to their summer. Still a lot of people logging in. This is probably our biggest registration for a webinar in a few years. So really excited about delivering this content to you guys today. So give it about another 15 seconds and we'll get started here.
Great to see a lot of interest in non-warrantable condos. Numbers are just up there as far as attendees.
Yeah, Scott. It's really exciting, and if you've joined us in the past, you see we've rolled out a new website. So a lot of great new things here at Angel Oak Mortgage Solutions. So all right, let's get started here. Just a couple of housekeeping rules. This is being recorded. Everything we're doing today is on our website. So this isn't a PowerPoint. This is live. We will send a recording of this out to you before end of day tomorrow. So let's get started. My name again, I'm John Gemini with Angel Oak Mortgage Solutions. Been here, just completed my 12th year, starting on number 13. And get the pleasure and the honor of introducing some of the top account executives, not just in the non-QM space, but in the overall lending space. Steve Arnold, please introduce yourself.
Thank you, John. Hello, everybody. Steve Arnold, South Florida. I'm in my 13th year with Angel Oak and over 20 years of the non-prime, non-QM industry experience.
Yeah. And Scott Grubel, please introduce yourself.
Yep. Good afternoon, everybody. Scott Grubel, account executive here in South Florida as well. I'm Steve's neighbor to the south, mostly in the Broward County area. I've been with Angel Oak for 10 years as of actually August 1st. So we'll be celebrating an anniversary here soon.
That decade, man. Nice. Steve, 13. So just on this call, what do we have? 35 years, 36 years just at Angel Oak. So it's impressive. So guys, again, today we're going to talk about everything condominiums, and you have two of the best of answering your questions. So everything put through the question queue. If we don't answer your question, we will have your account executive reach out to you. So let's get started. But before we jump into the website, we're going to put up a poll out there. Who has originated a non-warrantable condo in the last 12 months? So while that's going on, I've got some stats here. 13% of the loans we close here at Angel Oak are non-warrantable condos, which is a significant amount. And then just the top 5 states for condominiums are New York, Hawaii. I don't know why North Dakota is on there, but that's interesting.
There were some interesting states on that list.
Yeah. California, Florida's number 5. So you guys obviously are there. And then rounding out the rest of the 10 are Maryland, Minnesota, Washington, Colorado, and New Jersey. So
this is fun, John. We have almost 50% of participants are voting right now, which is high participation.
Very high. So Scotty, I don't know why I can't do this, but if you want to give me the results, that would be great.
Okay. Well, we're officially at 50% voted. Well, 51. 51% of those who voted have originated a non-warrantable condo. 49 have not. So it's pretty much right down the middle.
That's interesting. So 49%. So, this is a national webinar. So, wherever you are, you just heard me read the list, the top 10 states. So hopefully this is going to be an opportunity for you to continue to grow your business, not just with non-warrantable condos, but with non-QM business. So, all right, I just covered up my outline here. So, all right, Steve, we're going to cover the highlights of, again, like I said, everything is going to be driven from our website. So, Steve, you're going to cover the top part of our general requirements for Angel Oaks condominium. And if I need to make this bigger, Steve, let me know.
That's fine. I've got the extra cheaters on, so we're good. That's fine. Okay, so this is eligible and applicable to all transaction types: purchases, cash out, refis, rate and term, even delayed financing will apply. Low-rise condos, high-rise condos, there's no limit on the floors or the stories. Condo hotels, short-term rentals, we do as well, and we'll get into more detail on that a little later on. We do allow 100% investor concentration, which is large. That's big.
Yeah.
Up to 10% deductible on master condo insurance policy. That's another large item. Minimum square footage for non-warrantable condos is only 450 square feet. It does require full-size appliances suitable for year-round occupancy. It can't be a microwave and a mini fridge. So full-size appliances. New construction condos are also allowed. Condo conversions we do with 3 years of seasoning since the completion of the conversion. Litigation, we do a lot of litigation, but it's case by case depending on what the specific litigation is for. It could be slip and fall, water intrusion. As long as it's not like major construction or structural, we do make many, many exceptions and do allow litigation with a simple attorney opinion letter. Borrowers, permanent U.S. citizens, non-permanent residents, visa, foreign nationals, EAD, all allowed. There are no 40 or 50-year milestone structural or mechanical inspections required at all. No recertifications reports are needed, and no reserve studies required. Very, very simple here. Concrete restoration, I'm very familiar with because we went through a battle on that for the last 4 years. But concrete restoration, I get a lot of calls. The units don't have their balconies, they're in the middle of it, it looks terrible, etc. Concrete restoration is fine as long as no major structural safety issues are noted or commented on the appraisal. Restoration is a huge thing, and that is fine with us. Assessments are also typically fine. That's allowed. Reserves, we will allow less than 10% reserves. There's different tiers for that, but we can even do no reserves. It just lowers your LTV. So
Steve, I'm gonna stop you there because that was kind of Scotty's section. But Jay's asking a question. Any chance, and I'll ask this to you, Scott, any chance that a full-size oven requirement would be removed as an alternative? I can't see the rest of the question.
At this point in time, unfortunately not. We do need full appliances. So we do need the full range, stove range, and oven in a condo hotel.
So Scott, I'm going to have you cover the rest of this, all condominium projects. I know Steve started with it, but I kind of want to obviously mix it up here. So if you don't mind covering the projects.
Absolutely. So I think it's important to note that, and because we get this question a lot, Steve and I, for us, non-warrantable condos, it's a property type. It's not necessarily a program. So there's a misconception. A lot of people think, oh, a non-warrantable condo means that I'm going to be capped on my loan to value. That's not accurate. Your loan to value is going to be dependent on your credit score. It will be dependent on the amount of reserves that the project has, and we'll go into detail on that. But just because it's considered a non-warrantable condo does not mean you're capped on your loan to value. If the non-warrantable condo has sufficient reserves, which we see a lot of, it could be non-warrantable for a different reason, but have perfect reserves, and your borrower meets all program requirements with the borrower's qualifications, then they'll qualify for the max LTV that we offer on every single one of our programs.
Yeah.
So it's really important to note that before we go into these details. And so you can see, as I mentioned, our max LTV is 90% on our primary residences for bank statements and full doc. On investment properties, which we can go up to 80% LTV on a DSCR loan on a non-warrantable condo. and we actually go up to 85 LTV on our full doc and bank statement programs. These requirements that we see here are going to be more specific to the condo project, right? So for pre-sale requirements, if this happens to be a new construction, at our max LTVs, we would want to see that the project is 90% sold and closed, but that's not required. You can see 2 lines down, if it's less than 25% sold and closed, it's not eligible. So what that's telling us is that as long as your project has 25% of the units sold and closed, it's going to qualify if it's a new construction project. And keep in mind, guys, most builders are usually going to hit that pre-sale requirement in their initial phase of sales before they even go public and hit markets with it, because they realize just about every lender is going to have some minimum sold and closed requirements. So this is typically not an issue for us. Loan to value and reserves. Let's talk about those. So greater than an 80% LTV, we do want to see that the project has 10% in reserves. From 70% to 80% loan to value, we can accept 5% in reserves. And then 70% LTV and below, we don't require reserves at all. However, this is a big caveat, and this is where you want to take a note. We do not qualify reserves the way that agencies do. The agencies are only looking at what is being collected on the current year's budget, okay? At Angel Oak, what we do is we're going to take the amount that they are collecting on the current year's budget, but we're also going to ask the HOA on our condo questionnaire, what is the balance in the current reserve account? So, every HOA has a bank account in which they have funds from the previous year's collections of reserves. We're going to take the balance in that account, we're going to add it to what's being collected in the current year's budget, and then we're going to divide by the current year's operating income. And that's how we arrive to our qualifying reserve requirement. So guys, just with that calculation alone, we're able to save a lot of loans or take loans to higher loan to values than you would be able to with the agencies, of course, and also with most other even non-QM lenders, because that's a unique calculation to how we look at reserves at Angel Oak.
Yeah, Scott, thank you for explaining that. And you always do a great job explaining it that way. And it's really, like you said, it's how we can save deals. And, we talk about exceptions, and we get a lot of exceptions. I'm not going to put a percentage out there, but we do get a lot of exceptions. And that's why I want, I'm going to start early here. That's why having Scott and Steve and any of our other account executives across the country doing that pre-qual up front, right? We always talk about, a surety of execution. And that's one of the biggest reasons why, our pull through is extremely high, in the 70s. And because Steve and Scott do that pre-qual up front, they'll get those questions asked up front. And, we'll get into in a little while, we'll get into what our condo questionnaire even looks like and how easy it is to fill out. But yeah, thank you for sharing that, Scott. And I know we talked a little bit on programs. So Steve, if you want to take us through the programs that are eligible for our non-warrantable, and we'll talk about Condotel a little later too.
Absolutely. Bank statements and full doc. Non-warrantable condos are perfectly fine, and that's for all occupancy types. The primary, second homes, and investment properties are fine. And that program would go up to a 90 on the LTV on full doc and bank statements. DSCR, which is our investor cash flow, that will include short-term rentals, the Condotels, foreign nationals applies as well, but not on the Condotels. And then we go up to 85 max on the LTV under the DSCR product. Non-warrantables are just not applicable on the second liens and the HELOCs, but on all other programs, yes, they are allowed.
Yeah, and I kind of, I always say wait and see. We've had the bank statement HELOC out there for, probably it's almost 2 years now. So as we continue to get performance on those, we might be able to migrate those over to the non-warrantable program. So, Scott, let's talk about, we talk about our ease of use and ease of working with and doing prequals up front. Let's talk about this non-warrantable condo questionnaire here, and hopefully it'll let me open this up, or maybe not. There we go. So can you guys see this on the screen?
Yeah.
We can, but you might want to blow it up a little bit, John.
There we go.
Okay.
So Scott, just take us through a little bit of the details of our condo questionnaire.
Yep. So to preface, when we do a non-warrantable condo here at Angel Oak, guys, very important to note, as Steve kind of mentioned this earlier, the only document we require for a non-warrantable condo to qualify is this Angel Oak condo questionnaire. We don't need your budget. We don't need your reserve study. We don't need any other condo documents whatsoever. Obviously, master insurance policy, of course, HO6, et cetera. But in terms of the project itself, the only piece of documentation we need is this condo questionnaire. This condo questionnaire is a 2-page condo questionnaire with only 16 questions on it, guys. We are only asking the questions that we need to make a determination on lending on the project. And we're not asking anything above and beyond that. And that's why it's very brief and it's to the point. Page 1, you guys will notice, is all the standard, very basic questions you're going to see on most projects. Section 1 is just project and unit information. Are they fee simple? Are they the unit owners in control of the HOA? What's the total number of units? How many are sold and closed, etc. Of course, we do ask, does any individual or entity own more than 20% of the total units? If yes, we want to know how many those are. And then we do ask there if there are any litigations. If there happens to be a litigation, as Steve mentioned earlier, all we would need is a copy of the complaint and or an attorney opinion letter. Generally speaking, Steve mentioned it earlier, we're going to be okay with most litigations as long as they are not structural or safety related. Steve mentioned the slip and fall example. Sometimes you see contractor disputes with the HOA where they're suing a contractor or vice versa. Again, for the most part, those will not be an issue. We scroll down a little further in section number 10. We ask the basic questions you see there, where any of these, if they're checked, would be considered an issue for us to lend in the project. However, as you can see, these are standard questions you're used to seeing on any condo questionnaire. The only one I will mention is the second box, deed or resale restrictions. And we're pretty specific about saying other than board approval. So a lot of times when these condo questionnaires are filled out, the HOAs get confused and they mistake their ability to approve a new buyer in the project as deed or resale restriction. We're okay with that. Obviously, every HOA has the right to approve a buyer into their building, and we do not consider that a deed or resale restriction. So that should not be a reason why that box is checked. But you can continue scrolling down there, John. Standard questions number 11, and then we'll get to page number 2. So page number 2 is where we're going to see the majority of the information that we really are looking for, the numbers, we should say, the financials and insurance. So if you notice in question 1 of section 2, we are asking, are there any units that are 60 days or more delinquent? Okay, so what we're saying is that we are not concerned with delinquencies 30 days. The majority of delinquencies that you see in HOA projects are usually 30-day delinquencies that get cured right away. That's why we're not really as concerned with them. We're only looking at 60, 90, 120 days, so 60 and up. So very important distinction to make note of there on that question.
And Scott, interrupt 1 second here. A lot of our programs that we have, like our banks, that we allow a 1 times 30.
Yes.
Right?
Oh yeah.
So,
on mortgage rates or anything like that.
Yeah. So just wanted to bring that to everyone's attention too. So.
On number 2, here is where we're asking the individual filling this out to tell us what is the current operating income for the year and what is the amount of reserves currently being collected. And then you'll notice number 3, this is what I alluded to earlier, does the homeowners association have a reserve fund separate from the operating account? And if they do, what is the amount in that fund? What's the balance in that account? So we're adding the amount in line 3 to the reserve section from question number 2. and we're dividing it by the income that you see there in question number 2 to get our reserve requirement. Other than that, the remaining questions are basic insurance questions, and literally that is it, guys. So as you can see, we're not asking about inspections. We're not asking about any of the milestones whatsoever. We don't ask about assessments. We don't ask about any ongoing work or construction to the project or maintenance or upgrades. We are strictly asking the questions that we need to make a determination on lending on this project. And we don't need any other documentation, again, other than this condo questionnaire.
Scott, and you and I talked a little bit yesterday about, do we require for a warrantable condo, right? For us to price it and close it as a warrantable condo, we still do need agencies.
Our full review form 1076.
Correct.
Yeah.
Thank you.
Well, because we offer both options, right?
Right.
If project, so what happens is, if the project happens to be warrantable, if it's a full review warrantable project, and your borrower is a bank statement borrower, right? So they're not going to go conventional. They're not going to go to the agencies. We can do that loan and price that loan as a warrantable condo to get that borrower the best execution. However, if the project is non-warrantable, obviously you can see we have options for just about every reason why a project would be non-warrantable today to be able to qualify that borrower and get that loan closed for an originator.
Yeah. Yeah. So thanks, Scott. I'm going to switch it up here a little bit. Steve, I know I had Scotty kind of covering, but he's just been on a good roll. So I'm going to switch it up here. Steve, talk a little bit about Condotels.
Condotels, we offer exclusively on the DSCR program only. Short-term rentals, condotels, both allowed. Again, only DSCR. It has to be a. I'm just trying to think. It's separate. At one time we allowed different. Scotty, it just has to be a one building. It can't be in the same building as a hotel.
Correct. So when the high rise. Right, you're referring to the high-rise project, Steve. We would see usually on
Miami.
Exactly, on the coastline or whatnot, where it's a W hotel that happens to have a connected tower that has residencies. You're right, correct. Those are the types that we're not lending on currently.
Oh,
that's right. Okay.
But your vacation rental properties, the properties you would see in Orlando or in Siesta Key here in Florida and many other places throughout the country, your standard vacation rental, quote unquote, condotels, those we do all day long.
Yeah. Yeah. So guys, great. Anything else regarding condos before we move into, we're getting some questions in here. Have you closed a loan on a unit? Can't see that whole question. So again, guys, this is being recorded. Just going to make that announcement. This is being recorded. We will get this out before end of day tomorrow. Again, use that question queue there. We have two of the top account executives in non-QM and both in Florida. So there are experts in, non-warrantable, warrantable, and condotels. So
I think one topic, John, we should probably bring up while we're at it is insurance, right? Because, and I'm sure Steve will agree, insurance is one of the big reasons we see a lot of projects are being considered non-warrantable, because the agencies have very, very strict and tight insurance requirements, and they are actually increasing them. And we have, we see a lot of the higher deductibles that a lot of the homeowners associations put in place to reduce the cost of insurance to their unit owners over the course of the last few years. And Steve kind of mentioned it earlier, we allow 10% deductible on hazard, but we also allow up to a 15% deductible on windstorm, hurricane insurance, which is a big one. And we don't have anywhere near the minimum insurance requirements that Fannie and Freddie do. So it's very common that we see a lot of insurances that are not being accepted by the agencies, and we're able to get those loans closed as non-warrantable condos because we don't have those minimum requirements.
Yeah, and we developed, prior to this webinar, we developed a little bit of a fun fact sheet here for you. So it's available on the website. I just want to to talk about, the condo financing shift that's going on with the agencies. So we developed and hopefully it'll come up. Yeah. So this is available on our website. So again, this will be part of the recording we send out, but we also put it on our website to help you know what's happening. As Scott and Steve have mentioned, what's happening on August 3rd, and then the reserve funded minimum increases to 15% on January 4th, 2027. And then again, there's an ongoing scrutiny on project health. So all these are out there. What's changing at the agency, why originators should care. It's a really good document that you all have availability on our website to carry around with you or whatever. I know Scott and Steve, we've talked about this in the past. One way to really grow your business is to, if you find a condominium complex that is non-warrantable, right? And, reaching out to that realtor on there and knowing that you have a Scott or a Steve or any of our other account executives across the country as a go-to person for non-warrantable condos, why wouldn't you set up a presentation with that realtor who really, and most of them own that project. So let's talk a little bit, Steve, here on, excuse me, on a quick quote. So we know we do pre-quals up front. We call it a quick qual. So let's talk about how do we get rates, Steve, and then how do you get 1003 and a credit report to us?
Perfect.
Let me go back.
Also, let me add,
yeah.
If you email or send or upload during the quick qual to the AE, we'll review that condo questionnaire for you in advance to make sure everything looks good prior to even submitting it to underwriting.
Yeah. And that's the beauty of the pre-qual, right? And that's why we've got pull-throughs in the mid 70s, and we understand what those relationships look like, whether it's a referral source or the borrowers themselves. So, so Steve, how would someone get?
I was going to say that's a great point, Steve, because that's, the real life when the bullets are flying in the middle of the day. An LO might have a budget in their hands, might have a master policy in their hands, and they're just trying to get an idea of, will this project work? And so you guys can always send your account executive a copy of the master policy and whatever documentation you have at this moment. And we as AEs would be happy to review it and just, say, hey, look, from what we see here, everything looks good. Submit the file for a quick qual or a pre-qualification review, which Steve is going to show you how to do now. And then, we can get pricing out.
Absolutely. All right, so we're on the homepage, angeloakms.com, and you'll see on the top right-hand side or directly in the middle of the page, non-QM quick quote. You're going to click that. And we're going to hit broker for the broker channel. And let's do we'll do a DSCR.
Sure.
All right, we'll do a DSCR. Continue. That's just advertising that we do all for 7-year ARM. Loan amount, let's just do that's fine, whatever you have there. $300,000 loan amount. Purchase, we'll do a 7, whatever you have there, 1 unit. You can change that. You want to change that to non-warrantable condo, or are you going to show them first?
Oh, yeah. That's a great point. Thank you, Steve.
Go non-warrantable condo.
Do a 30-year fix. Oops, sorry.
30-year fix. Prepay is flexible. Leave it the way it is. Default if you want.
Yep.
Okay. We're going to DSCR. We'll just do the standard over 1.
Right.
All right.
75 LTV.
75 LTV is fine. That's an average. First lien, 0 times 30 on the housing history. No late on any mortgage or rent. State license, we'll put yes. Compensation, borrower paid.
There we go.
And then it's gonna auto-populate. You'll see the rates there, whether it's par or lender discount buy downs or even lender credits, where we'll give a credit back at closing towards closing costs to the borrower. So the par rate that I'm looking at is actually 125, so 6.624.
So that's pretty amazing, Steve. You're doing a non-warrantable condo, and you're not. So we picked debt service coverage ratio. So you're not providing income, job information, right? And you're getting a rate in the 6s. I mean, that's pretty, and it's a fixed 30-year fixed. So, I mean, that's pretty impressive.
At what LTV do we have in there, John? Is
It's
that 80?
75 LTV.
75 LTV?
Yeah.
There you go.
Yeah, that's,
And we
and
can
you know,
take,
go ahead, Scott.
yeah, I said we could take the scenario 80 if we wanted to.
Yeah. So it's really, you know, so the difference between agency rates right now and non-QM is it's very, very skinny right now. So it's not much. And
since you're on here and we're talking DSCR, we're actually pricing better than the agency is as of today on investment properties. That's a little fun fact for originators to make note of. You will find non-QM loans, especially on DSCR product, is pricing better than the agency. Look, the agencies, they're getting out of investment property lending. They're getting out of, you know, higher risk condo lending. We're seeing it happen, and that's part of this whole discussion.
yeah, and that all started, Scott, right after COVID, right? They started putting these LLPAs on second homes and on investment properties because they didn't want any more of that business. And so that's why, you know, non-QM has continued to grow like it has, you know, well, for the last dozen years, but, you know, especially in the last, you know, half decade or so. So Steve, so right now, if I click on this 6.624, you know, what happens? Did I lock it?
No, this is just for the pre-qual purposes, for the quick qual. So you're going to click on any rate there. It makes no difference. You're not locking. And then you'll proceed to the next page there, which you see what you'll enter a subject property address, the county, the company, etc.
So Steve,
and it'll actually take you,
yeah, I'm sorry. So this is interesting. We kind of fell into this doing this on the DSCR. So why are we asking for the subject property address?
Because we, at our cost, we will run during the quick qual stage, we'll run an AVM on the rent to see in advance, so we don't have to wait for the appraiser to do a Form 1007 per se. We're gonna calculate and try to get you an accurate DSCR during that quick qual stage with our AVM.
So I need you to say it again. So again, we talk about a surety of execution, right? So knowing all this stuff up front as an account executive and doing that quality pre-qual, I mean, repeat that, please.
And this is almost like a junior underwrite. We're spending good time in going through this file and giving you the best pre-qual you can get out there in the industry. But we will run a rental AVM for you during this quick qual stage to come up with the market rent in advance.
Yeah, that's amazing. And then you're saving if it works, you're saving the borrower not having to get a 1007. We still require an appraisal, but they're not having to get a 1007. And we'll take the greater of the three, Steve, right? The AVM, the 1007, or the canceled checks.
On a refi, you can use actual rent. So the best of the three.
Yeah. So that's amazing. So Steve, after they fill out all this information, they upload the 1003, credit report and any additional documentations, whether it's the condo questionnaire or anything else that they have regarding insurance and reserves.
Exactly.
You hit submit. What happens?
You hit submit, then it goes into the queue of the AE that you're going to select from the dropdown after you enter your information as the LO for contact. And then within 24 hours, sometimes just a matter of a couple hours, the AE is going to review it thoroughly and get you back something in writing.
Yeah, and I think it warrants reiterating that on non-warrantable condos, we'll do full doc, bank statements, debt service coverage ratio, we'll do foreign national. All those we will do on a non-warrantable condo. So I love the availability and the options out there. And with affordability becoming still a sticking point, condos are getting a little bit more popular. And like I said, 13+% of our loans closed on a monthly basis are condominiums, non-warrantable condos. So this is great. So let's talk a little bit about how we can help everyone on this call. And we have a great group on this call, how we can help them market themselves and these programs, not just non-warrantable, but all the great programs that Angel Oak has. So Scotty, you want to take me through that?
Yeah, actually, if we can do a quick pit stop, John, before we do that, I want to show everybody this little cheat code and how easy that we make it for everybody. If you hit on broker resources.
Yeah.
So guys, all of the documentation you'd ever need for any Angel Oak loan can be found right here in the broker resources section. If when John scrolls down here, you're going to see where we have our non-warrantable condo questionnaire housed right here on our website. So you guys can pull it up and take a look at it. But we also have the Form 1076 full review condo questionnaire. But what I wanted to show everybody as we get there is the answer key.
Oh, okay. Let me go back there then, Scotty. Sorry. This is live, like I said.
There we go. So here's your non-warrantable condo questionnaire, and look at how easy we make it, guys. If you hit on that answer key, it's going to open up the document that shows you exactly what the acceptable answers are for every single question on our non-warrantable condo questionnaire in order to get that project approved. I don't think it gets any easier than that.
Yeah, Scotty, and even we talked about the concentration. If it's I've gotten exceptions in the past on condos where if a person was purchasing it and someone did own 20% or more than 20%, but our borrower was buying it as a primary, we've sometimes gotten that exception. So I just wanted to throw that out there. So
sure.
Yep. So
sorry.
No, great point, but great.
Back to marketing. So Angel Oak offers for all approved brokers with us, we offer a full suite of marketing products that you can access to market not only the non-warrantable condos, but any product that we offer, bank statements, DSCR, Fortinet, et cetera, HELOCs, et cetera. So you, as a broker, when you log into our portal, you will be able to go into the marketing portal and you'll see the full suite that we offer. And it includes flyers, it includes social media posts, it even includes a PowerPoint presentation. It's a white label, fully customizable PowerPoint presentation that any one of our originators can download and customize with your logo, your contact information. You can adjust any of the data on there. We give you all the data you need to market and talking points for non-warrantable or non-QM products, but you can also edit it to add in any other products you might offer. So John is logged in here. Go to that marketing portal. And here you go. Here you can see we have a flyer available for every single product that we offer. So while we're on the topic, we'll go to our condo flyer.
This is a condo tel flyer, Scott.
Okay, there you go, condo tel flyer. So as you can see, John's picture is populated there, but as an originator, they can add their picture there, their contact information. They can add their logo in the top left-hand corner in place of the Angel Oak logo. And you guys can print these, save them to a PDF, blast email them to your database. These are, 100% free to any originator that is approved with Angel Oak.
What's the cost of this, Scott?
Free 99.
Free 99. I like it. I love it. Yeah. So, and the great thing about this, once you fill out your contact information for one flyer, it populates all of them. Now, yeah, I put my stuff in here. This really took me no more than 2 minutes to fill out. Mm-hmm. So, I mean, and like Scott said, we have a ton of flyers available. Scott, let's also look at social media.
Yeah, social media posts, because that's where most people are doing their marketing nowadays. Mm-hmm. So check these out, guys. We break it down by social media outlet. LinkedIn, we have LinkedIn posts that are more specific for the images to appear on the LinkedIn type style post. We have Instagram style posts, Pinterest, and we also have some Facebook posts. So basically, every non-QM product you can think of, bank statements, DSCR, non-warrantable condos, there's a flyer or an image with some verbiage that you guys can literally just copy paste into your social media channels to post about these products and programs. We have some that are designed marketing directly to borrowers, and then we have a whole nother set of them that are designed to market directly to realtors and referral sources. So depending on what you wanted to post, we have different options available to you as an originator.
Even as a flyer, Scott, and I know Steve, you're a flyer. We have flyers to CPAs, right?
Yep.
So we do a lot of self-employed bank statement borrowers out there. So
It's free.
we've even created. Go ahead.
It's free content for any loan originator to be able to use and put out there.
We have so much content available for originators out here, Scott, that they could probably go on a weekly non-QM marketing campaign and have different content on a weekly basis for an entire year.
Absolutely.
It's mind-numbing. And this is where I get, our website we had before was, serving underserved borrowers. And, this is where I get a little, stand on my soapbox. This is where, if we have a lot of people on this webinar, they'll get off it and they won't change any of the habits that they've had before. And we have all this content for you to market yourself differently. And I know we're going to talk about this next, Scott. Let's talk about the presentation. And I know you and Steve and all our account executives across the country do them on the originator's behalf.
Mm-hmm. So yeah, this PowerPoint presentation, this is powerful. And as it's downloading here, again, I mentioned it earlier, this is a Microsoft PowerPoint presentation that any loan originator on this call can download, save to their desktop, invest a little bit of time in to customize to your liking. Again, put in your logo, put in your contact information, put in your color scheme for your company, your organization, and edit any of the content on there that you like. But the base is we are providing you with a full presentation that you can present to your realtor referral partners talking about non-QM products and programs. You can add a slide to talk about a down payment assistance program if you want to. You can add a slide to talk about any agency product or program that you want to offer as well. But everything you need for non-QM is right here, fully customizable. You invest the time to do it once, you can save it, and then use this anytime you do a presentation to any of your referral partners. I personally have some accounts that have done that. They've created the PowerPoint, shared it with every LO in their organization, and these guys go out and do presentations constantly. I can tell you that one of the best ways to fill up a room with realtors is to talk about non-warrantable condos, DSCR loans, bank statement products, all of the different alternatives that you see with non-QM. Those are usually the types of products and programs realtors are interested in hearing about because, they've heard about agency loans, they've heard about DPA programs, they've heard about any of these other products and programs. They're used to them, but these are the ones that they are not as familiar with and they want to learn more about. So it's a great way for a loan originator to pack some people into a room, and we give you the tools to be able to present to them.
Yeah, Scott, we have an AE here in Dallas, and he Google searched real estate investment groups, and he stopped counting at 20. And he took one of his loan officers to one of those real estate investment groups luncheons and presented this similar type of presentation, but scaled it down just to get Jack's customer call, just to investment property. So debt service coverage ratio, right? So he's and they had half the room had never heard about a debt service coverage ratio program. So I think there's so much opportunity out there, guys. We continue to try to educate the originators out there, and we'll help you educate. I think, what is it, Scott? 49% have not closed a non-warrantable property in the last 12 months. Guys, this is an opportunity to take advantage of this. Mm-hmm. So, Steve, anything else? And I know we're probably closing here, 15 minutes left, but got through this a little quicker. But Steve, anything in closing that you want to just share with the group?
I would in fact, I've got a lot of loan officers that it could be warrantable, but they want the simplicity of the minimum documentation, and they just call it, they take it non-warrantable to avoid having to get the bylaws and the covenants and the inspections and the reserve studies, avoid all that. So I would just say this is a lot simpler than some people may think it is. And Don't be afraid of it. We're here. We're going to look at the questionnaire for you in advance.
Yeah, and that's the part I love, Steve, that, go back to the assurity of execution. We're going to look at that two-page condo questionnaire. I mean, that's real easy. And, so it's got just ease of use. Like you said, Steve, even if it's warrantable, they'll go non-warrantable, just not to take it all that other extra documentation. Sorry, Scotty, anything else in closing?
Yeah, John, could you bring up the flyer, the new flyer that we housed, so that everybody can take a peek at that? We'd love to talk about a couple of points on there specifically.
Yeah, let me shut out of that.
And as you're pulling that up, so as we all know, guys, the agencies have made significant changes to their guidelines in how they're looking at condo projects.
So Scott, what do you want me to pull up? The flyer we just made?
Yes, sir.
Okay, sorry.
Yes, sir. So the agencies have made significant changes, and those are being implemented. They're starting to be implemented as early as August 3rd. On August 3rd, we're going to see their first wave of changes kick in instantly to their guidelines. And then on January of 2027, the rest of them will take effect. Basically, guys, what is happening is all of the projects that no longer qualify conventionally, and there are many of them as we pull this up and we'll go over it, they have now become non-warrantable condos. So as an originator, it is imperative that you're aware of this and you're aware of these options that we're offering. So as you can see here, as of August 3rd, conventional agencies limited review is being retired. LOs, you guys know, in the past, the limited review questionnaire basically dumbed down all of the information that was being asked. It eliminated a lot of the questions that, had they been answered, may not qualify that project. And so a lot of originators would use limited review as a tool to get a loan through and closed a lot quicker and easier. That's gone now, right? So any loan or any project that you previously thought, okay, I'll take this limited review, it's now a non-warrantable condo. You now need a non-QM lender partner to be able to close that loan. January 4th, reserves are going to be 15% across the board for the agencies. That project will not qualify unless they're collecting 15% in the current year budget, not the way we calculate it. How many projects is that going to eliminate from qualifying agency? And we went over how we do it. And as you can see, that's another round of projects that are now instantly going to become non-warrantable condos, right? So this flyer is available on our website. We go into a little bit more specifics on it below, but the point I wanted to make here in finishing, John, is that, guys, the market is shifting. The changes are coming. And this call was all to help educate all of the originators on here on how to get ahead of that shift.
Yeah, Scotty, well said. And like you say, what is it? January, what's the date? January 4th?
January 4th.
Okay. So, I was on a webinar last week, and the person leading the webinar said, "What are you going to do for your fall business?" So I'm asking everyone on this call, what's your plan for your fall business? Because you can't just change it. It has to change today to change your fall business, right? And your 2027 business. What's your plan? Make a plan, work the plan. So hopefully, everyone, on this call and everyone who's getting the recording of this, like I said, this is recorded. Everything was done on our website. We will get this out before end of day tomorrow. But, we had a great group here. Guys, you learned from two of the best, Steve Arnold, Scott Grubel. You learned from two of the best, and any of our other account executives across the country can help you close non-warrantable condos, not just non-warrantable condos, but everything from self-employed borrowers to investors with debt service coverage and even full doc loans. So on behalf of everyone here at Angel Oak, thank you for your time today. We appreciate you. And hopefully today you learned a lot and will, hopefully send us some business going forward. So Scott, Steve, thank you for your time. and everyone have a great afternoon.
Thank you, guys.
Appreciate you guys.